Welcome back to the deep dive. Today, we're really getting into something fascinating. We're tracing how futures markets work, starting with, physical stuff like corn or oil.
Right, the traditional commodities.
Exactly. And following that path all the way to Bitcoin, it's quite a leap. Our mission really is to see how this old financial structure adapted to something so well new.
And if there's one word, just one, that you need to grasp to understand all of this, it's standardization. That's the absolute core.
Okay, standardization. So a futures contract is basically a standard agreement, right? Buy or sell something later at a price set now. Legally binding.
Precisely. Standardized. That means every contract for, say, December corn is identical.
And why is that the magic ingredient? Why standardization?
Because it creates interchangeability, that's fungibility, and crucially, it allows for massive scale. When everything's the same, you can trade them centrally, frictionlessly.
Right.
And that directly leads to the powerhouse of the system, the clearinghouse.
The clearinghouse. It's not just keeping track of trades, is it? It's doing something much more fundamental.
Oh, absolutely. It's the guarantor. It literally steps into the middle of every single trade. It becomes the buyer to every seller and the seller to every buyer.
So you're not worried about the person on the other side freaking out.
Exactly. Your risk isn't with them anymore. It's with the clearinghouse, this massive regulated institution, that elimination of counterparty risk. That's everything. It's the foundation of trust for the entire market.
Okay, that makes sense. And that security, that trust, it must attract specific kinds of participants. You need people using the market.
Right. You have two key groups. First, the hedgers. Think of a corn farmer worried about prices falling before harvest, or an airline needing to lock in fuel costs. They use futures to manage, to mitigate that real-world price risk.
They're transferring their risk into the market.
Precisely. And someone has to be willing to take that risk on. That's the second group, the speculators.
The traders looking to profit from price movements.
Yes, they absorb the risk the hedgers don't want, betting on whether prices will go up or down. And in doing so, they provide the essential liquidity. They make sure there's always someone ready to buy or sell.
Now, let's talk about the high-octane part.
Yeah.
Leverage. This isn't like buying stock where you pay the full price.
Not at all. With futures, you only put down a small percentage of the contract's total value, the notional value. That deposit is called initial margin.
So a little bit of capital controls a large position.
Exactly. And that's where the magnification comes in. Let's say margin is 5%. If the underlying asset price moves just 1%, your gain or loss on that margin isn't 1%, it's 20%.
Wow. Okay, so huge potential gains, but also potentially catastrophic losses very quickly.
Absolutely. High risk, high reward.
So how does a system built on that kind of leverage not just blow up? If one big trader gets wiped out, doesn't that create a domino effect?
That's where the market's immune system kicks in. It's called mark-to-market. It's relentless.
Daily settlement.
Yes, at least daily, sometimes even intraday. The clearinghouse calculates everyone's profits and losses, and actual cash changes hands. If your account balance drops too low because of losses, boom, margin call. You have to deposit more funds, or they close your position.
So losses can't accumulate indefinitely. Debts are settled immediately.
Correct. It prevents one participant's failure from cascading and threatening the whole clearinghouse, the whole system. It's a constant pruning of risk.
Okay, so we have this highly structured, standardized, risk-managed system. How on earth did it adapt to Bitcoin? I mean, Bitcoin is sort of the opposite, decentralized, volatile.
Well, the first crucial step was regulatory. In 2015, the U.S. regulator, the CFTC, made a key decision. It classified Bitcoin as a commodity.
Like corn or oil.
Exactly. That classification gave the established, regulated exchanges like the CME Group the green light they needed. It provided a legal framework.
But they couldn't just use the same contract structure, could they? You can't exactly arrange for physical delivery of thousands of Bitcoin at a warehouse somewhere.
Right, good point. No physical delivery. They had to tailor the contract. Bitcoin futures are typically cash settled. Meaning at expiration, instead of actual Bitcoin changing hands, the difference between the contract price and the spot price is paid in cash. It neatly sidesteps all the complexities and security headaches of handling actual crypto.
But there's still a unique challenge, isn't there? The underlying Bitcoin market trades nonstop, 24/7. Futures markets traditionally don't.
That's a big one. While futures do trade almost around the clock now, there's still that gap between the traditional market close on Friday and the reopening on Sunday. Bitcoin can move a lot in that window. It creates weekend gap risk that institutions have to manage carefully.
So despite the challenges, this regulated futures contract became a sort of Bridge.
A bridge, a translation mechanism, maybe even a Trojan horse, you could say. It allowed big institutional players, hedge funds, asset managers, to get exposure to Bitcoin's price movements without having to actually buy, store, and secure the underlying Bitcoin themselves. It plugged Bitcoin into the existing financial plumbing.
And looking at those futures prices themselves can tell you something, right? This idea of contango and backwardation.
Absolutely. It's a real-time sentiment indicator. If futures prices are higher than the current spot price that's contango, it generally suggests the market expects prices to rise, or that there's a cost to holding the asset. If futures are lower than spot backwardation, it often signals current scarcity or strong immediate demand. It gives you a read on market expectations.
But no matter how wild the speculation gets or what the price structure looks like week to week, there's an anchor, isn't there?
There has to be. It's the iron law, price convergence. On the final day, the expiration date, that futures price must equal the actual spot price of the underlying asset. Arbitrageurs make sure of it. If there's a difference, they'll trade to capture that risk-free profit until the prices align.
It proves the futures market, for all its complexity, stays tethered to the real-world economic reality of the asset.
Ultimately, yes.
So the fact that this centuries-old standardized system managed to wrap its arms around a decentralized digital asset like Bitcoin, it does make you wonder. Here's something for you to think about. What other novel, maybe volatile asset class that's currently outside the mainstream regulated system, what might be next to be domesticated by the power of the futures market?